Hi guys, welcome to Starter Wealth, where we give practical and actionable advice to starting your wealth and creating and maintaining your business. In the times of COVID-19, all businesses are scrambling to react. Don't get caught behind. It's clear now that for small businesses, we're going to be in a prolonged period of paralyzation. We want to make sure you're aware and taking advantage of every resource out there. The current primary small business resources are the two different loans offered by the federal government via the Small Business Administration, both of which are available to all small businesses, which includes independent contractors. One is the PPP loan, and the other is the EIDL loan. Today, we'll be discussing the ins and outs of the PPP loan. But keep an eye out for the next video, where we'll also tackle the details of the EIDL loan. If you want to stay up to date on all the details, make sure you hit that subscribe button. Our aim is to keep the information flowing as fast as it's changing for these mercurial times. And if you want more research, deeper analysis, and links to tools, check out our website at starterwealth.com. Before we begin, some important things to note. The deadline for the PPP loan is August 8th. Originally, applications were only accepted through June 30th, but the government extended the deadline, so make sure you get your applications in ASAP. This is also the second round of PPP funding, as the first round dried up real quick. In my opinion, there's unlikely to be a third round of funding for small businesses, so I would get my application in well before the deadline. Okay, let's start with the basics. What is the PPP loan? Well, quite literally, it is the Paycheck Protection Program. The initial intention of this program was to shore up employment across all small businesses. Basically, the government through this program would turn small businesses into unemployment insurance providers. Because let's face it, small businesses in the beginning of COVID largely had to shut down. So giving them funds to pay employees they didn't actually need just made them unemployment insurance processors. Fast forward a couple months and some of the logistics of the program have changed. We'll be discussing those as we go on. The most attractive part of the PPP loan is that it is 100% forgivable, as long as you satisfy all of the conditions. Do I need to repeat that? It is 100% forgivable, which means you do not have to pay it back as long as you adhere to the conditions of the loan. The loan itself is based on 2.5 times your monthly payroll or labor expenses if you don't run an official payroll, i.e., if you're an independent contractor and pay yourself via regular checks and not via a W-2 paycheck situation, this still applies. The PPP loan must be used to cover 8 weeks or 24 weeks of payroll. Or if you get your loan in August, then you'll have however many weeks from the point you receive your disbursement up until December 31st, 2020. You can elect which time period you want it to cover. There are certain strategies to choosing any of these methods. You can also elect any time period in between the 8 or 24 week duration, like 9 weeks or 10 weeks, etc. The main concern in choosing a time period is that if you are to reduce wages by more than 25%, that also reduces your loan forgiveness amount for the entirety of the period, which again is either 8 or 24 weeks or anything in between. If you know you are going to reduce your wages by more than 25%, you would opt for the lower number of weeks. Let's skip forward to an example. So if you have an employee, let's say John, who makes $80,000 per year and you reduce his wages to $56,000, that is a reduction of 30%. Remember, the PPP only allows you to reduce wages by up to 25% without it affecting your forgiveness amount. So the difference between 30% and 25% will be taken off the top of your loan forgiveness amount. What that means is if you look at the allowable reduction of 25% in our example, that equates to an allowable reduction in John's salary of $20,000. So we could have reduced the salary to $60,000 from $80,000 because $80,000 minus the allowable $20,000 is $60,000, and we would have still been able to have our loan fully forgiven. However, because we're in one of those businesses, let's say like hospitality, which has been brutalized by coronavirus, we had to reduce John's salary by $24,000 instead. So we exceeded the allowable reduction by $4,000 because $24,000 minus the allowable reduction of $20,000 equals $4,000 not allowed. Now, to amortize the unallowed portion, we have to divide by 52 weeks in a year. Then you have to apply that weekly unallowed reduction against the entire duration of your elected period. So, if you chose an 8-week period, you have to multiply by 8 weeks. And if you chose a 24-week period, you have to multiply by 24 weeks. You can see that by choosing 24 weeks, your loan forgiveness amount decreases by 3 times that of the 8-week period. So if your loan was originally for $100,000 and the full amount would have been forgiven except that you reduced salary by more than 25%, in this example, if you chose the 8-week period, you have to subtract $615.38 from your forgiveness amount of $100,000. And if you choose the 24-week period, you have to subtract $1,846.15 from your forgiveness amount. Additionally, your payroll costs, including health insurance and retirement benefits, must equal 60% of the total loan in order for the loan to be forgiven. If you miss that mark, the loan forgiveness will be reduced by the amount that you missed in the same way in which we just discussed the salary reduction example. The remainder of your loan can be used to pay down business mortgage interest, rent, and utilities. But honestly, if you don't need to reduce salaries by more than 25%, I would use the whole amount of the PPP loan on as many weeks as it'll cover of my payroll. That way, I don't have to worry about the minimum requirement of 60% being spent on my payroll expenses. And the last basic point to mention is that you must apply for loan forgiveness. It's not automatic. Because the government, of course, loves its paperwork and loves to make it difficult for the little guy. The process for this will be different based on the bank you get your loan from, and we will discuss what that looks like more towards the end of the video. So what are the loan terms for the PPP loan? Well, they are super favorable, so that even if you don't meet the qualifications for forgiveness, the penalty is just 1% interest. Total. Yes, I said 1%. Additionally, loans issued prior to June 5th get 2 years to be paid back, and loans issued after that date get 5 years to be paid back. What's more is that loan payments are deferred for 6 months, meaning you don't have to pay a dime back for 6 months after you receive the money. However, interest will continue to accrue during those 6 months. That little 1% baby interest. The next one is a biggie as well. Anyone who's tried to get an SBA loan for a startup or new business knows that you usually have to provide collateral, and as a new business, it's usually personal collateral. But not with the PPP loan. No collateral or personal guarantee is required. What this means is that if you were to default or worst case close your business before payback is due or complete, your personal assets would not be seized. However, and we will cover this later on our channel when we talk about financial literacy, the big caveat is that any loan default or, God forbid, bankruptcy filing is a huge black mark on your credit. It can and will make it incredibly difficult to access significant credit again when you need it later. So don't do it. Just don't do it. And the final major piece of the loan terms is that neither the government nor lenders will charge small businesses any fees. Those of us who have been through setting up lines of credit or even personal HELOCs know how much credit fees can add up to. So you're probably wondering exactly who qualifies for the program. Well, any small business and any independent contractor qualifies. Yes, any, basically. From mom and pop restaurants to Uber drivers and housekeepers, from legitimately registered S-Corps and LLCs to Joe Schmo and barely registered DBAs. The key is that you have to be able to prove your payroll costs. Again, whether that's via actual paychecks accompanied by a W-2 at the end of the year, or in the case of the self-employed contractor, via handwritten checks to yourself personally, where you receive a 1099 at the end, as long as you can prove your compensation, you would qualify. Now, if you own your own company and you have multiple employees, only the amount you pay to W-2 employees would factor into your loan calculations. This is because any independent contractors or 1099 workers that you pay are eligible to apply for their own PPP loan. So you cannot count independent contractors into your loan amount. Let's move on to calculating our loan amounts with some examples. First, you have the option of either using calendar year 2019 or if you weren't in business from February to June of 2019, then you'll use the average from January 1st to February 29th of 2020. The dates may seem arbitrary, but the pandemic basically shut down everything by the second week of March, so it makes sense that February 29th is the cutoff for calculations. Looking at our first example, if you're a sole proprietor or other setup like an S-Corp with only one employee, basically yourself, then you would do your calculation based on how much you paid yourself only. So, if you paid yourself $80,000 in annual salary with no health insurance or retirement benefits, your PPP loan is the equivalent of $80,000 divided by 12, which gives you your monthly salary of $6,666.67. Then you multiply by 2.5 to get your PPP loan amount of $16,666.67. If you're maximizing your deductions as a business owner, you're probably paying benefits in the form of health insurance and/or retirement benefits, and you probably want to know how that factors in. And if you're not doing that already, that's something else we need to discuss in our financial literacy series. Moving on. Let's look at example number 2. And say you pay health benefits of $450 per month and your employer, which would be you if you're self-employed, once again, let's say your employer contributes the max to your 401k, which was $37,000 in 2019. You would add up the annual salary, annual health insurance, and annual employer 401k contribution to get your total of $122,400. And then, just like the example before, we divide by 12 and multiply by 2.5 to get your loan amount of $25,500. That is how much you would get from the PPP loan. In our next example, we're going to look at the PPP loan cap of $100,000 per employee. The PPP loan limits your calculations to the first $100,000 in salary for each employee. What this means is, let's say you have a small business with 3 employees. Jack makes $125,000. Diane does the same job but only makes $105,000. You know, hashtag equality. And Steve makes $50,000. The PPP caps Jack and Diane to $100,000 each, while the full amount of Steve's pay counts towards the calculation. So instead of $125,000 for Jack, only $100,000 counts. Instead of $105,000 for Diane, only $100,000 counts. So, following the same calculations as our previous examples, add the annual salaries up, divide it by 12 to get your monthly, and then multiply by the PPP multiple of 2.5. The loan amount is thus $52,083.33. One of the ways you can increase your loan amount is by counting your employee benefits into your calculations, just like we did in example number 2. But the real advantage to this is that benefits are not subject to the $100,000 salary cap. You get to count benefits on top of the $100,000 salary cap. That means if you have an employee who makes more than $100,000, their benefits would be in addition to the $100,000 cap. Let's look at Diane again. She makes a $105,000 salary, so as we learned, only $100,000 of that will count towards the calculation. However, all of her health insurance and employer 401k contributions would also count. So back to the example, $450 per month in health insurance plus the $37,000 in employer contributions to her 401k would all count. However, only $100,000 of her salary counts. $100,000 plus the health insurance plus the employer contribution equals $142,400. Then you divide by 12 once again to get the monthly rate, multiply it by the 2.5 PPP multiple, and you get $29,666.67 as the PPP loan amount. If we compare the difference between calculating the loan with benefits versus without benefits, you'll see without benefits, it's $20,833.33 versus with benefits, it's $29,666.67. You can see that there is a significant material difference of about $9,000. What about payroll taxes? Well, the unfortunate thing is that only state and local payroll taxes count. Usually that's just state unemployment insurance, which is super minimal. FICA, federal withholdings, state income tax withholdings, none of that count. Only state and local payroll taxes from the employer side. Now that you understand how to calculate your loan amount, you can check your calculations using my handy PPP loan calculator, which I've linked below at starterwealth.com/PPP-loan-amount-calculator. So what are we going to need to actually get the loan? You have to prove your payroll costs in order to do it. The easiest way to do that is to have copies of your employee W-2s or your own 1099 if you're an independent contractor. But you can also provide payroll reports in lieu of W-2s or check copies in lieu of 1099s. In order to get loan forgiveness, it would be best to pay yourself through a legitimate payroll company like a Paychex or ADP, even if it means you're going to pay more in payroll handling fees than if you just cut yourself a regular old check. We'll revisit the criteria and process for loan forgiveness as more guidance comes out. Currently, the process is just now being implemented across banks, and some banks like City National Bank won't even have a mechanism to apply for forgiveness for another 6 to 8 more weeks. Okay, now onto the brass tacks. How do you actually get the loan? These loans are provided by regular banks, the majority of which are already SBA approved. From Chase to Bank of America, Wells Fargo to Citibank, and even your regional banks like Southwest Missouri Bank and Bank of the West, to tech banks like Cabbage and PayPal. You have a plethora of banks to choose from. You should do a test run and fill out the paper application. I'll link to it in the description below. That way you know the important inputs that will be required of you no matter which bank you apply with. Application processes are going to vary greatly from bank to bank, and some will require a lot more proprietary paperwork or online forms. But the bulk of the tricky questions are all the same and contained in the paper application from the SBA. One final tip. Apply with a regional or tech bank. That would be banks like Cabbage, QuickBooks, Fundbox, and Fundera. And if you have a regional bank, that's the best option. PayPal used to accept PPP applications, but they stopped June 30th. A lot of banks have already stopped accepting applications, so you're really going to want to get your application in as soon as possible, as we never know when banks or regulations will change. I can tell you from my own personal experience that regional banks are definitely the way to go if you have an account set up with one. Because unless you are with a specialized department at the larger banks, like at Chase or Bank of America, you will be lost in the shuffle and they will just rote process your application. What that means is that if there are any hiccups or anything they can't automatically verify with what you turned in, they will just deny you the application loan. In my case, I included my solo 401k contribution into my calculation. If you don't know what a solo 401k is, stay tuned as we'll have a video on that very soon. Effectively, because my solo 401k proof of contribution was not included in the paperwork, because they didn't ask for it, they denied my loan after weeks of waiting. Keep in mind, this was before Congress extended the PPP loan into a second round of funding, so I thought I had completely lost the opportunity, as by that point the program had run out of money. Luckily, I was able to reach out to my regional bank in Missouri, and they took care of me. They were proactive in communicating any missing info or gaps, and within a week, I had the funds in my bank account. It's that fast. And most banks will deposit the funds directly into your account. There's nothing precluding you from applying with multiple banks if you're worried and want to make sure at least one of them goes through without issues. I simultaneously applied with PayPal as well, and their whole process was a breeze. There were no issues. It was just that my Missouri bank got my application in with the SBA first. If you're interested in any of the tech banks, I've included links to some options below. Keep in mind, with all these banks, you will need to have a pre-existing relationship with them in order to apply for a loan through them. So make sure you open an account ASAP if you don't have a viable bank option for the loan already. Good luck.